produzione Corax, social media company.
Welcome back to The Bull, your personal finance podcast. In many among the 269 episodes before this one, in my 2 books, and in countless conversations about finance and investing, I've often mentioned the extraordinary work of a professor from Arizona State University, Hendrik Bessembinder. In 2018 and 2023, Bessembinder wrote 2 of the most cited papers in the financial world, where he highlighted a fact that is as simple as it is essential for any investor to understand. A tiny fraction of companies, between 2 and 4% of the total, is responsible for 100% of the stock market's net return. In practice, out of the 64,000 global stocks examined from 1990 to 2020, only little more than 1,500 of them generated the whole market excess return over the risk-free rate. All the others, collectively, roughly match the return of a money market fund or a 1-month treasury bill. This seemingly absurd and counterintuitive discovery is a milestone in the understanding of stock investing and its deeper dynamics, and it has become a foundational pillar for every investor who wants to make sensible decisions throughout their financial life. For this reason and many others, I'm thrilled to have brought Hendrik Bessembinder here on The Bull and to have spoken with him about the most famous, cited and debated finance paper of the decade. Without further ado, I'll leave you to my conversation with Hendrik Bessembinder. Enjoy the episode. Dear Professor Bessembinder, welcome to my podcast, The Bull.
Well, thank you. Thanks for inviting me.
It's an invaluable honor to have you here. I always tell anyone interested in finance, if you had to read one paper in your lifetime, let it be one by Hendrik Bessembinder. They're amazing, insightful, and mind-changing when it comes to understanding what it really means to invest in stocks. Therefore, thank you so much for this privilege.
Well, I really I appreciate your saying that. Thank you.
Yeah, I know that you had to attend a lot of podcasts, interviews, and so on and so forth in the last year because your latest papers received an impressive amount of attention. Everyone wanted to know more about them.
Yeah, I was somewhat busy for a while, but I guess that's good. It's good to have people interested.
Yeah, definitely a good choice that you didn't mention the words skewness in your paper titles.
You've seen some of my prior podcasts and my discussion of the strategic choice of the title for that first paper.
Yeah, good choice in hindsight. Would you tell us why your paper have become so successful and widely cited everywhere? You discover something both simple and amazing about the skewness of long-term stock returns, especially when it comes to single stocks, as it's very different to invest in the broad stock market and in single securities. And there are a lot of myths that fall apart once reading your works.
Yeah, so, I think the paper got a lot of attention because I documented something that's there in the markets that wasn't widely known. And in fairness, some people did have a sense for this. Maybe they had an intuition for the fact that long-term outcomes would be skewed. We have to use that word because it is ultimately these papers are largely about skewness in outcomes. So some people did have intuition for it, but I don't know that anybody had systematically documented it before. So a lot of people were surprised. And I think the potential change in the worldview, many of us have had in our mind the idea, yes, we know that investing is risky, but it's kind of symmetric. It's kind of 50-50. You might do better than expected. You might do worse than expected, but it's kind of symmetric. What we find when we actually compound returns, the properties of compounding when it's interacted with randomness are just not that intuitive, I think, for a lot of people. So, but when we actually think about that or actually look at it in the data, we see the skewness, and that means it's not 50-50. The odds, we can talk about the average outcome, but most possible outcomes are lower than the average. So that's I think that's important, and it wasn't widely understood before.
Since we are in Italy, I mostly refer to your 2023 paper about global long-term shareholder returns, because the data set is worldwide and not only focused on the US stock market, so it's more relevant for us as investors. The idea that only 2.4% of the best performing stocks account for all the shareholder returns over that time span from 1919 up to date, it's incredible and really hard to accept. When I tell people these statistics, they often reply to me, no, it's not possible. It's not possible that a bunch of companies deliver so much return and half of them are mediocre investments that return less than a treasury bill or a money market fund.
Yeah, so a lot of people are surprised, and particularly initially, I think a fair number of people had the reaction that, he must have done something wrong. He must have computed something wrong. But it's been, I guess, almost 10 years, 9 years or so, now 8 years since I first circulated the paper, and numerous people have dug into the data and replicated the results. They're definitely there. So maybe we learn the most from the things that surprise us. One thing that I should clarify, though, in the set of papers, I assessed outcomes in two different ways. One is buy and hold returns. So for somebody who hypothetically buys the stock or the group of stocks, just holds it, except that they reinvest dividends. So that's one way I measured things. The other way I measured things was what I called wealth creation. And part of the reason I also looked at wealth creation is that buy and hold with reinvested dividends, while it's a nice simple strategy, it doesn't pertain to a stock market as a whole. It doesn't reflect the outcome of investors as a whole, with the key difference being that collectively we don't reinvest dividends. Some people occasionally...
Yeah, because it would be impossible.
It would be impossible. I occasionally see some people saying, well, Bessembinder got it wrong. He assumed no reinvestment of dividends. Well, first of all, he one of the measures I did, but the other measure takes into account, as you correctly said, it's impossible for us to collectively reinvest dividends. So the other measure is intended to get at the collective experience. But collectively, we live in a value-weighted world. Big companies are more important than small companies collectively. Anyway, so the second measure, besides fine points like it doesn't assume reinvestment of dividends, at least not in the stock market, is that it is based on dollar amounts. So it's partly driven by, we have big firms, we have small firms. So it's a combination of the skewness in returns and differences in size of firms. And those act together to give us outcomes like only 2 or 3 or 4%. Depends on exactly which sample, which period. But those come together to give us the outcome that in dollar terms, only 2, 3, 4% of companies explain all of the premium over risk-free investments.
Okay, interesting. Your work are the typical ones that different people take into account to support very different positions. They become somehow the ultimate basis for whatever you want to demonstrate. Are there common misunderstood takeaways from your research that you see out there?
Well, in some sense, your observation that people take away what they want to take away is correct. I don't think people are necessarily getting it wrong. There's more than one potential lesson here. In terms of things that actually, people seem to really get wrong, is the number that you just referred to a minute ago in the global study. Let's just say 3% for sake of discussion, that all of the value creation over and above what we get from treasury type securities is explained by about 3% of the stocks. Some people say, well, that implies that 97% of the stocks underperform, which isn't actually correct. Going roughly speaking here, it's about 58% of the stocks underperform. Then about 38%, 39% of the stocks actually add value, but only enough to offset the losses from the 58. so that when we add those together, you have 96 or 97% of the stocks that collectively match low risk investments, treasuries. And then the rest of the gain, the wealth creation in the markets comes from 3%. So that's probably the single thing that gets repeated incorrectly. But back to interpretations, I don't think everybody has to have the same reaction. And clearly, not everybody does have the same reaction. Some people say this just strengthens the argument for diversification. And I say, you're right, for many people, maybe for most people. Other people say, well, this just shows us that it's all about a few stocks, so it's all about trying to identify those few stocks. And I'd say, I think you're right if you're one of the people who have that comparative advantage. The big question is who has the comparative advantage?
Yeah, if you're from Omaha, Nebraska, that would be a good idea.
Yeah. So, Warren Buffett is an interesting case study, but something I've said before, it is worth thinking about. There's more people who claim they're just like Warren Buffett. Probably even more people who think they're just like Warren Buffett. Then there are people who are just like Warren Buffett.
Yeah. There's a widespread myth about diversification. Namely, the idea that investing in a broad set of stocks is useless because if you pick, let's say, 20 stocks or so, that would be enough to be diversified and to get your healthy share of the stock market return. What do you think about this die-hard idea that comes along occasionally?
Yeah, so, there's a lot of things that are partially true, but that doesn't mean that, we should necessarily run with everything that people say is an implication of that. So, diversification is still very effective. And it is true that as few as 20 stocks gives you a lot of diversification benefit. But we do still get more benefit beyond 20. And, these rules of thumb that, 20 stocks is enough to diversify, 30 stocks is enough to diversify. They were based on research that was done decades ago. And they were focused on short horizon returns, like monthly returns, for example. So I have a few follow-on papers, and I'll just mention if anybody's interested, the website Social Science Research Network at ssrn.com. All of the papers I've done are there. So I've done a few follow-on papers. One of them I titled it "Extending Portfolio Theory to Compound Returns." Basically taking the Markowitz framework and saying, well, what if we look at returns compounded over multiple periods? Anyway, the reason I bring it up is that for compound returns, the risk reduction isn't as rapid as it is for, say, monthly returns. So, a rule of thumb like it takes 20 or 30 to be well diversified. It's not as simple as that once you look at longer horizons. But still the point that you get a lot of diversification benefit, even at longer horizons from as few as 20, 30, 40 stocks. Okay, that's true. On the other hand, there's no great harm in diversifying further as long as you can do it at low cost. As long as there's some low cost funds available to do it. So some people say that, diversifying broadly guarantees mediocrity. Okay, you could call it that. You get the average in some sense, but you could do a lot worse than the average. And for many investors who don't have particular stock picking skills, maybe they're smart but they're busy, they have other things to do. For many people, just diversifying makes a lot of sense. Not for everybody. Some people perhaps have the comparative advantage, or some have what we sometimes call skewness preference. If you're a little less charitable, you call it gambling preference. If you have those preferences, then you really don't want to completely diversify. Diversification reduces skewness. So if you have, I've never thought it was my job to tell people what their preferences should be. If you have a preference for skewness, you have keeping the dream alive, I like to call it, the dream of big riches. If you have those skewness preferences, I'm not going to tell you shouldn't. I just want you to be informed. And the skewness means unless you do have some extra skill, the odds are against you if you don't diversify. It's worse than 50-50 that you'll underperform the people who did diversify.
Yeah, great. It's an old topic about figuring out if one has a true skill or just random luck or simply hybrid exposure to different factor premia. It's difficult to tell in advance if one has a real competitive advantage.
Yeah, you're probably familiar with the work from Fama and French, and I think others, about how much data would you need so that the data alone could tell you if you're skilled versus lucky. And the answer roughly is not in our lifetimes. Will we figure it out just from the data?
Yes, I was a little cheating because as you can see here behind me, there's Fama's work, a complete collection, and he used to be a former guest of this podcast. That said, I feel that whenever the average investor thinks about average returns, there's often a misunderstanding between mean and median. I think that the skewness of return you have brilliantly highlighted tells something very important about what you expect to get, the arithmetic average, the mean, and what you are most likely to get, the median, which is not the same. Could you please expand on that further?
Sure. So that's actually a very good way to think about what the insights are that have come from my work, is that the mean and the median are different. And in much of what we discuss, in particular in academic finance, but also in investment management, much of the discussion focuses on means. When we talk about the expected return or the equity risk premium, those are statements about the mean. And there's a lot of debate about what is the mean. What equity premium should we anticipate going forward? Let me put this in terms of a financial planning example. You're planning for your own retirement, or maybe you work at a pension fund. You're managing a pension fund where you have to think carefully about these issues. And one of the key questions is, well, what's the risk premium for going into a risky asset class like the stock market? All right, let's just say, for sake of discussion, that we were able to figure that one out, that we know that the risk premium, okay, it's 6% per year, or whatever we agree on. All right, good news is we've nailed it down, the expected return premium 6% per year. So we can do our compounding with that, and we can say, okay, we expect to have this amount of money 20 years from now, 25 years from now. But expect refers to the mean of the distribution. We remember there's still risk. Now, the additional thing to take into account is that when the distribution's skewed, the median will be less than the mean. And if there's a lot of skewness, the median will be a lot less than the mean. And as you said, the median is half of the outcomes are better, half of the outcomes are worse. Anyway, bring it together. When you have skewness, even if we nailed down the expected premium, most possible outcomes are going to be worse than what we would expect based on compounding the premium, compounding the expected return.
Yeah. In fact, your actual terminal wealth may be disappointing.
Is likely to be disappointing. And my papers were about individual stocks, but the basic point that when you compound random returns, you get positive skewness. That applies to portfolios also. It's just to a lesser degree in portfolios than it is in the individual stocks.
Sure. Thank you. You mentioned earlier the equity premium, which is famously a puzzle since 1985 Merriam-Prescott paper. According to any economic model, stocks shouldn't be delivering that high premium, or at least they did deliver it in the past. In the future, who knows? Anyway, 5-6% on average over bonds is difficult to reconcile with our risk aversion, the actual riskiness of investing in stocks, variation in fundamentals, etc. Could this extreme skewness you discovered help explain the equity premium puzzle? Something like investing in stocks is that rewarding because of the extreme dispersion of their returns, for which the investors in aggregate request a high compensation.
It's not really clear, so I won't rule it out, but it's not obvious that it does. So even though people have not really in the past highlighted the skewness in compound returns, when people, people smarter than me, better mathematicians than me, when they do models of multi-period investing, models that, for example, say that you should maximize the expected utility of a lifetime consumption stream. All right, mathy sort of stuff. But my point is, when they put those models together, the skewness is implicitly there, even if nobody really shone the spotlight on it. So I think even in models that implicitly allow for the skewness, it's still viewed as a puzzle. On the other hand, I think a place that there might be something for the argument that this helps to explain the equity premium puzzle. Standard models have diversified investors. The sort of mathy models that I was just talking about that involve mathematical skills that I don't have. They still presume everybody's diversified. But we know that many people, in fact, are not broadly diversified. A lot of people have narrow portfolios. In fact, there's evidence that people go out of their way to get volatile and highly skewed portfolios. You think about people trading zero DTE options, or you see people trading levered ETFs, levered or inverse ETFs. Those are in some sense ways to make the long run show up sooner in terms of getting the skewness to show up sooner. In any event, a lot of people, in fact, are not broadly diversified. And to use a little bit of econ speak, if the marginal investor, the investor whose order flows, buys and sells, are actually determining the prices, if they are not well diversified, then they're taking on more risk than what the models said. So, maybe there's an avenue there.
Interesting. Broadly speaking, there are two forces active in the stock market. Well, not only in stocks, even when it comes to bonds, commodities, and currencies, it's quite the same. But let's stick to stocks. In the short term, short to medium term, the market tends to be autocorrelated to create momentum and trends. On the other side, every once in a while, we know there is a kind of mean reversion. Of course, it's very difficult to know in advance when the market has finished its run and it's about to drop, and the other way around. According to your work's results, how should the typical investor behave when she has to decide whether to let her portfolio drift away from the starting allocation or rebalance it, trying to match the next reversion to the mean, whatever the mean is?
Yeah, so I'm going to disappoint your listeners by not having a firm, clear answer here. Momentum is an anomaly. I think it might have been Gene Fama who called it the granddaddy of anomalies, or words to that effect. We don't really understand why there seems to be momentum in stock returns at the medium horizon. It's actually a little easier to understand why there might be reversals at longer horizons. If this expected return that we talked about, if it varies through time, if the discount rate varies, that actually should give us some mean reversion if we give it enough time. So that's easier to understand. But in terms of my work, you don't actually need momentum to get the sort of results that I'm documenting. The pure mathematics of compounding random returns is enough to give you the skewness that we see. And I've done a little bit of work on this in another one of the follow-on papers. I think the title is something like "Probabilities of Big Gains," something like that, if anybody's looking for it. But I looked at stocks that reached certain multiples, like 5x since the last trough, or 25x, or 125x, or 625x. I kept increasing it on that sequence. Anyway, I looked for stocks that had reached that multiple, and then formed portfolios of stocks that had reached the multiple, and then looked at their returns after hitting the benchmark. And basically, there was no trend, market adjusted. There was no trend after hitting the benchmark. So it doesn't really look like it's anything as simple as momentum that's driving the outcomes. But I think there's also there's some deep, almost philosophical questions lying in the background, I think. So On the one hand, if we just have, we have a positive mean return, and then we have randomness in the outcomes, and we have multiplicative compounding. That's enough to give you a lot of skewness. But I think it might oversimplify the world. And I've used this analogy before. You may have heard it, but maybe your readers hadn't. If we take, for example, Amazon, and you, I've never talked to Jeff Bezos, but if he was here and we chatted with him and we said, Bessembinder said, the outcome on Amazon investments could all just be randomness. My hunch is he would be offended by that. He would say something like, look, I had a brilliant strategy from the start, and eventually the market came to discover how brilliant my strategy was and saw how well it worked. That's not randomness. But if we didn't know how brilliant it was, if we had to learn how brilliant it was, that might appear to be randomness to us. But anyway, I guess what I'm getting at is there really might be some structure, there really might be some momentum, but not that of the sort that can be easily exploited by just looking at what the recent returns were.
Yeah, thank you. A little bit disappointed for the answer because I wanted to establish my hedge fund out of it, but it's okay.
I sometimes joke that some people are trying to get the advice that will guarantee they'll be rich by next Friday, and I keep disappointing those people.
In your papers, a bunch of uber-performing stocks stand out, with Nvidia and Apple being among the few mega winners.
Yeah, they do. Although you made the important qualifier ex post. I'm not, I'm sure in your prior podcast, you've had some discussions about market efficiency and how efficient are the markets and such. It's a huge question, of course. I don't know exactly how efficient the markets are. What I do know is that if you're thinking of a way to reliably make abnormal returns out there in the market, just recognize that there's a lot of smart competitors trying to do the same thing. It's not enough to be smart. You have to be smarter than those smart competitors. It's really competitive. I think that's something we can count on. So it is, of course, very difficult to find observable variables like anything you would find in the accounting data or stock market history, volatility of returns or anything like that. It's very hard to find things that are going to reliably predict who ends up in the right tail. But ex post, as you said, we can look at the firms and say, well, what did they have in common? And maybe that'll guide us. So roughly speaking, the firms that end up in the right tail tend to be growth stocks. But I need to qualify that that's not the way some people define growth stocks, as say stocks with a high ratio of market value to book value. Matter of fact, I found that in trying to predict who ends up in the right tail, the market to book ratio at the beginning of the period really didn't explain anything. But they actually have rapid growth in fundamentals. So assets are growing, cash balance is growing, cash flow is growing, net income is growing. So fast fundamental growth seems to be a characteristic of firms that end up in the right tail. Now it comes down to being able to forecast who's going to have that fast fundamental growth.
In your papers, a bunch of uber-performing stocks stand out, with Nvidia and Apple being among the few mega winners. Do these incredible companies share common characteristics, at least in hindsight?
No, not that simple at all. No, a good many of the firms that end up in the right tail, at least with benefit of hindsight, look like growth stocks. But predicting who's going to be there, that's harder.
A massive discovery over the last 30 years has been that different factors contribute to risk and return beside the market beta, the original factor behind the CAPM. Now, factor investing has become a milestone in quant investing. Somehow, factor investing is a way to figure out the winners ex ante. Do you think they will still be reliable going forward? Or were they just random things that used to happen in the past and we just believe they will hold in the future too? If I overweight, for example, quality stocks or value stocks, can I expect to come ahead in the future? Does your research help to shed light on this topic?
Factor investing has some plausibility to it. We do know that on average, several of these factors, we can talk about specific ones, but several of these factors have worked out on average in the past. We also know that they can disappoint us for substantial periods of time, 10 or 15 years. But it's been there in the past. One weakness is that for the most part, the factors didn't come out of theory. They're something that were noticed in the data, which brings up the possibility that people use pejorative terms like data mining or specification searches. But the truth is there's a lot of people looking for any interesting pattern. So there is a danger that people will end up documenting things that are really just random in the data. But that said, I think in my view, the collective evidence is that the factors do have some explanatory power. But as I said, they can disappoint for long periods of time. For those of us that don't think we have a comparative advantage in identifying the next Amazon or the next Nvidia, the diversification argument is strong, but the traditional value-weighted portfolio, trying to match what the capital asset pricing model calls the market portfolio with value weights. That's not the only way to have a diversified portfolio. As a matter of fact, this should be about my research, not my personal investing, but to partly answer your question, I personally no longer have any money in the traditional value-weighted market portfolio. And I've tilted slightly towards value and quality. There's certainly no guarantee, but it seemed that alternative way of diversifying seemed reasonable to me. They're just to fill in a blank there. In the U.S. in particular, our value-weighted portfolios become quite concentrated, and it's not that I think I can call the market, but I feel like I can have a better diversified portfolio than the value-weighted portfolio.
Are you concerned about the current concentration level?
Exactly. Concentration is the concentration, the high percentage of the market cap accounted for by the 7 or 10 biggest firms is exactly what I had in mind when I say I think you can get better diversification than a traditional capitalization weighted portfolio.
Okay. I try to connect the two things here. Many wise people claim that it's time to move away from market cap weighted portfolios to, for example, equal weighted portfolios, with the idea being to tilt the portfolio toward smaller stocks. In your research, it stands out clearly that there is more skewness among smaller firms. Does this make a stronger or weaker investment case for overweighting smaller stocks, in your opinion?
Well, I think it's a little bit in the eye of the beholder. It's related. It's related to the question of skewness preference, but it's also related to this question of what's the most effective way to diversify. So as I was just saying, I don't, holding the value weighted market is not the only way to diversify. And, maybe the first alternative to that would come to mind is an equal weighted portfolio. But there's lots of other ways to have diversified portfolios also. In terms of the small firms in particular, there has been over the decades a small firm premium, a higher average return for small firms, although that's one of the ones that's not so reliable. Sometimes it disappears for a decade or two. But that would suggest that one might consider tilting towards small stocks. They are also more skewed, which I showed, and then you have to decide whether you like a lot of skewness or not. The skewness gives you a better chance. Maybe you'll have a better chance of finding the next Amazon among the small stocks. But again, once there's skewness, the odds are against you. The odds are they'll underperform. Failure rates are higher among small stocks.
Yeah. Okay. Yeah. You must be prepared that the journey will not be smooth.
So that's also true, and that's even true for the stocks that end up in the right tail. So among the various follow-on papers that I did was one about documenting magnitudes of drawdowns. And just going from memory here, because I haven't reviewed the paper recently, but even stocks like Apple and Amazon that end up near the top of the leaderboards had very large drawdowns at points in their history. So even if you can identify the big winners, you should not expect a smooth ride.
Yeah, I think that the expected median drawdown for any single stock is close to 80% over a long enough holding period. So when investing in single stocks, one must be well prepared to these extreme outcomes.
Indeed. And that's even those that succeed have big drawdowns. And then to throw another statistical term in here, the mode, the most frequent outcome. The most frequent outcome for individual stocks is losing everything, negative 100% in the long run.
Yeah, I couldn't highlight it enough. Because this podcast is mostly about index and systematic investing. It doesn't endorse stock picking, market timing, and active stuff in general. Nonetheless, it's difficult to convince people about it, and that it's harder than one typically thinks because you always see outcomes that now seems obvious and therefore replicable in the future. Now, it's obvious that you should have invested in Apple 15 years ago. It's obvious that you should have invested in Nvidia once ChatGPT was launched in 2022. It's always obvious ex post. Prices are always wrong in hindsight. Even Gene Fama agrees on that. But it's a very different story looking forward. And even if you are sure to be careful and wise and thoughtful in your stock picking, your most likely result will be disappointing.
Yeah, I think there's a few things that come together here that actually make it more difficult for particularly individual investors to decide on their strategy. And I view my papers as, helping to educate people so that hopefully they can make better choices. But there's a few things that come together. One is selection effects, and maybe I contribute to that a little bit when I in my papers include lists of the best performing firms, shining the spotlight on the ones that turn out to be the winners. Although if you look at my papers, you can also find a link to a spreadsheet that has outcomes for every firm in the study. So if you want to focus on the ones that did the worst, you can find them as well. But anyway, there's a natural tendency to shine a spotlight on the winners. And if you're in a bulletin, so I've done it. The financial press does it. If you're in a bulletin board, the discussion is going to be about the winners. The people who are on the bulletin board are going to be talking about their winning picks, not their losing picks, although there were plenty of losing picks. And then marry that with the fact that many of us have a tendency to be overconfident. And you can see the problem coming together.
Your 2018 paper, Do Stocks Outperform Treasury Bill, was focused on the U.S. stock market, while 2023 long-term shareholder returns addressed the global stock market. Did you find relevant differences between the U.S. and ex-U.S. stock market?
Well, big picture, it was the same. It was the same finding. There's a lot of skewness in compound returns. It was actually a little bit stronger outside the U.S. than in the U.S. By the time I did that study, I was pretty sure what we were going to find. I mean, I didn't know for sure that it would be slightly stronger skewness outside the U.S. than within the U.S. But myself, I went from being initially surprised when I first documented these results to coming around to, well, we shouldn't have been surprised. It's hardwired in the math of compounding random growth rates. And I had come to that conclusion before we went to the international data. So I was not at all surprised to find that there were similar outcomes outside the U.S. as in the U.S. And to go a little further, in my original paper, I did some simulations, but there's a couple of talented econometricians in Sweden, Adam Ferrargo and Eric Harmarlisson, who have better mathematical skills than I do. Anyway, they've done a follow-up paper where they worked out very carefully the mathematics of compounding and skewness. And they showed rigorously the main thing that determines how much positive skewness you get in compound returns is the volatility of the short horizon returns. And I believe it's the case that on average, markets outside the U.S. are somewhat more volatile than in the U.S., not night and day, but a little bit more volatile. Anyway, when you bring these together, it's not surprising that you find a little bit more skewness outside the U.S. than in the U.S.
Yeah, that makes sense. If we try to look into the future, well, I know it's very difficult, but we give it a try. Looking backwards, it seems that something has been changing in the market structure. If we compare it with what it used to be in the past, for example, we have now things like widespread use of index investing, a wider participation through the stock market, the algorithmic trading, a lot of social media noise, and so on and so forth. And there is a winner-take-all environment with very few big winners in the broad economy, few mega behemoths that never existed in the past at that scale. The question is, do you expect the skewness to increase in the future?
So I'm not certain. The one thing I feel confident about, projecting the future is always a risky business. But the one thing I feel confident about is that there will be skewness in the future. There will be a relatively concentrated wealth creation. And that's because I've come to the conclusion that this is just fundamental. It's hardwired in the mathematics of compounding at random growth rates. So I feel confident saying there will be skewness in the future. And I've documented in other of the follow-on studies that in, say, the last 20 years or so, the degree of skewness is increasing. Now, will that trend continue? That I'm less sure of. Because a lot of things can change. On the one hand, you can argue that the internet has, in the last 20 years, enabled winner-take-all type outcomes, which is a plausible argument. But what's AI going to do? I don't know the answer. Is AI going to make this trend stronger of winner-take-all outcomes, or is AI going to make it easier to launch firms and to identify market niches, segments that individual firms can serve better and therefore reduce concentration? I think it's an open question.
Yeah, there is no easy answer to what an investor should be doing going forward, beside investing with a diversified portfolio.
Yeah, and I don't want to overstate. I really do think diversification is the best strategy for most investors. But I do believe the world has some Warren Buffetts. There is the overconfidence danger of people who think they're Warren Buffett when they're not. But somebody who really has the right insights. Should have a narrow portfolio. And as a matter of fact, the market needs some people who are willing to invest with conviction. We need it for price discovery. We need it for capital to be allocated efficiently. So most people should diversify. Some people should not. Among those who have the right comparative advantage or think there's a reasonable chance that they do, it's hard to be sure, right? But among those who have the comparative advantage, they should be thinking hard about these questions and thinking about, where are the opportunities to profit in a skewed marketplace? Venture capital investors, for example, it was more obvious to them sooner than it was maybe to the rest of us that this is not just a venture capital phenomenon, but venture capital investors have long understood it's all about identifying the few.
Even in the public stock market, at least according to the Grossman-Stiglitz paradigm, there should always be a tiny space for active investor to outperform the market, isn't it?
In equilibrium, there should be opportunities for people with the right comparative advantage. And I, that economic reasoning seems very solid to me.
Yes, as we said earlier, it's very difficult to know if you do have a competitive advantage.
Exactly. There's the difficult part. Is it, do I have the advantage? Do you have the advantage? Can I tell if you have the advantage? Those are the hard questions.
Okay. Last question. if you were to advise a 30-year-old investor, what is the single most important advice you would give her? I have an idea about it, but I'll let you say it.
Yeah, so we almost got there already. I think for a 30-year-old investor, you've still got a lot of time. The old adage about time in the market is still really important. How does one reliably gain wealth from stock market investing? Give it time, which involves take the risks. So time in the market is crucial, and that's not new advice. The other one we were just touching on is the central question of comparative advantage. What is your comparative advantage? And for the vast majority of individuals, picking stocks is not your comparative advantage. First of all, because of the tough, smart competition out there. Second, because maybe you have other things to do in your life. You have your own profession. You have your family, etc. So for most investors, trying to find the next Amazon is probably not your comparative advantage. For a few investors, it might be. The analogy I've brought up before, and I think it's one worth thinking about. If you have the right comparative advantage, if you have the right skills to be a professional football player, the payoff can be tremendous. But what percentage of the population has the right comparative advantage? So, we certainly don't tell every kid, focus just on your schoolwork and don't spend time on your athletics. We don't tell every kid that, but for many kids, that's good advice.
Yeah. In Italy, most parents think their son are the next Cristiano Ronaldo, so it's the same thing when it comes to investing in stocks. Most people think they have competitive advantage, even if they have not any.
Exactly. And the one other thing I'll throw in the mix, even if you're realistic about comparative advantage, maybe you have skewness preference. I mean, there's a lot of indication that a good many investors have skewness preference. So I see the parallel to gambling. In some sense, you might be better off nurturing an interest in gambling in the stock market as opposed to in a casino, where we know in the casino that on average the customers are losing. In the stock markets, on average, the customers are winning. So maybe you're better off pursuing your interest in skewness or gambling preference or whatever in the stock market. And if you just view it as a form of entertainment, okay. But try to make your decisions with full information, including that your odds are stacked against you.
Yeah, that's a great advice. Professor, it was a remarkable opportunity to have you here. Thank you so much for joining us today.
It was my pleasure, Ricardo. Thank you.
Bye-bye.
Bye.